When it comes to ETFs, they come in all shapes and sizes. An S&P 500 ETF is probably the most popular, followed by a triple Q ETF, which is a growth tech-heavy focused. And then you have things like SMH, which is another popular ETF. But one that gets talked a lot about and is found in a lot of portfolios is the number one dividend-focused ETF, and that is SCHD, or the Schwab US Dividend Equity ETF. It is far and away the most popular dividend ETF on the market today. However, in the past few years, SCHD has lagged the S&P 500 in a big way. Looking here at this fiscal AI chart, you can see that over the past 2 years, the S&P 500 has risen 63% to SCHD only rising 19%. Huge outperformance on the part of the S&P 500, or huge underperformance on the part of SCHD, depending on how you look at it. And a question I get a lot of times over the past 12 to 24 months is the fact that, Mark, is it time to move on? Is it time to sell SCHD? And that's what we're going to talk about in today's video. Dive into the performance, the top holdings, and what I believe is the plan moving forward for SCHD. So make sure you stay tuned throughout the entirety of today's video. And if you could show your appreciation just by simply clicking that like button down below. I truly appreciate it. Really helps with the growth of this channel. And let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And when it comes to investing, my number one go-to resource is Fiscal AI. You see charts on almost every video that I put out here on YouTube, whether we're talking about ETFs or stocks, growth stocks or dividend stocks, it doesn't matter. Fiscal AI makes investing so much easier for us retail investors, as they have great charts, endless amounts of data, and the power of AI to summarize earnings calls, press releases, and non-financial data. And right now, when you use my link down in the description below, you can get yourself 15% off any of their paid subscriptions, and you can even try it out for free for 2 weeks. So definitely give Fiscal AI a try today. All right, let's jump back into our video, focusing purely on SCHD. When it comes to the ETF, they track the return of the Dow Jones US Dividend 100 Index. It's a low-cost fund with an expense ratio of just 0.06%. And again, for me, I always focus on low-cost ETFs. It focuses on maintaining a diversified portfolio of companies that pay safe, reliable, and in many cases, growing dividends. SCHD has a total of 100 holdings, which we'll take a closer look at here in a second. But this is an ETF that updates its holdings every year, and there really is no human element, hence the low expense ratio. The algorithm written for the ETF is the same every year. This blurb you see on your screen here comes from SCHD's prospectus, and it states that all index-eligible stocks must have 10 consecutive years of dividend payments. It must have a market cap of at least $500 million and meet minimum liquidity requirements. Once those stocks are narrowed down, the evaluation process then focuses on 4 fundamentals: cash flow to total debt, return on equity, dividend yield, and 5-year dividend growth rate. No single stock can dominate the ETF with a weighting of more than 4% at the time of balancing. This process is known as reconstitution, and it takes place every single March, resulting in some stocks leaving the portfolio and some stocks being entered into the ETF's portfolio. I got a number of questions, or if you view them as complaints from viewers talking about why in the world would SCHD remove Broadcom from their portfolio a few years back. And it wasn't that there was a human element of someone choosing to remove it, it's the fact that it didn't fit the bill. The stock had grown so much, it went from paying a 4% yield down to paying less than a 2% yield. And it didn't fall in those top 100 because the yield fell so much. Remember, when it comes to dividends, dividend yield has an inverse relationship to stock price. And Broadcom, over the past few years, has been one of the best performing stocks in all of the S&P 500. Looking back over a 5-year period from say 2019 to 2023, SCHD grew 63%. And when we look at 2018 through 2022, through the depths of the pandemic, SCHD grew nearly 75%, actually outpacing the orange line you see on your screen, which is the S&P 500, which generated returns of 54% during that 5-year time span. But what happened at the start of 2023? It was the beginning of a massive AI boom, or bubble, depending on who you ask. And we continue to be in that phase right now. And over the past few years, the top performing sectors in the S&P 500 have been technology and communication services. And when you look at those sectors of where they stand in SCHD, they're not even in the top 5. Thus, when we look here at this fiscal AI chart showing the S&P 500 versus SCHD over the past 3 years, SCHD is getting left in the dust. And since we're on the topic of sectors, let's jump right into it and take a look at SCHD's sector breakdown. And as you can see, the top 5 sectors include energy, consumer staples, healthcare, industrials, and consumer discretionary. Technology, again, not even in the top 5. So when people complain about the lack of performance of SCHD over the past few years, they have to understand the breakdown and the makeup of this particular portfolio. It's meant to be a diversified portfolio. It's not meant to be a huge growth driver. It's not meant to rely heavily on technology-focused companies. But again, for those of us that invest in SCHD, we don't want it to be those things because we invest in the S&P 500 for those. We invest in the triple Qs for those. We have growth-focused ETFs and individual technology companies for those. If we continue pouring all of our money towards that, yes, our portfolios are going to be great over the past few years. But when stuff hits the fan, our portfolios could get smoked. If you look back to 2022, which was the last time the S&P 500 came under siege, you would see the likes of Nvidia, Tesla, CrowdStrike, AMD, all of these popular companies found in many portfolios out there. Those stocks were down as much as 75%, and it took a lot of digging out until we got positive again. When you look at something like an S&P 500 ETF like SPY, you can see that technology now makes up nearly 40% of the entire index, with 4 of the 5 top companies by market cap all being tech companies. Looking at the popular QQQ, another ETF found in many portfolios, again very tech heavy, with exposure to the sector amounting to more than 55%. Look at VUG, a popular Vanguard growth ETF, again, technology at the top at 55%. SMH, all technology. Many of these ETFs are found in thousands of portfolios, millions of portfolios across the globe. But when it comes to building long-term sustainable wealth, it's important to be well diversified. It doesn't mean we need to be exactly even keeled to all 11 sectors in the S&P 500. No, we want to be overweight certain sectors and underweight certain sectors at different times. But we don't want to be 90% in just 2 sectors. We can find ourselves getting in big trouble like we did in 2022. So when it comes to SCHD, we're not going to find technology in the top 5 sectors. We're not going to find communication services in the top 5 sectors. And that's perfect because that's what makes SCHD the best complement to the likes of a tech-heavy portfolio, to the likes of an S&P 500 large position, to the likes of a triple Qs, SMH, individual tech holdings. SCHD is a great complement that when stuff in fact hits the fan and when you see investors start to rotate out of those sectors and ring the register on many of those growth stocks, SCHD is going to be there to hold your portfolio together. And again, we've been on this AI boom for a few years now, and it's not something that's just going to go on forever. The AI story can continue, but we're starting to see cracks in the economy, starting to see major cracks in the labor force. And if consumers are losing jobs, they're not spending money. And if they're not spending money, GDP is going to come down. So we could start to see a rotation. And that's why SCHD is going to remain in my portfolio. But even when SCHD isn't outperforming, I'm still earning a great, solid dividend, one that continues to grow. And speaking of the dividend, right now for investors of SCHD, you could earn a near 4% dividend yield. You're going to get a 10.5% 5-year dividend growth rate and an ETF that has grown their dividend for 13 consecutive years. This is an ETF that has a higher yield than most high-yield focused ETFs. This is a dividend ETF that has faster dividend growth than most dividend growth focused ETFs. It checks off a lot of boxes. Now let's take a look at the top holdings within SCHD, which include the likes of Cisco, Amgen, AbbVie, Merck, Lockheed Martin, Coca-Cola, Chevron, PepsiCo, Bristol-Myers, ConocoPhillips, the Home Depot, and Verizon. Very high quality companies, but not crazy growth stocks. And at the top It's dominated by healthcare and energy. But the funny part is the fact that the top stock right now happens to be a technology company in Cisco. Again, a well-diversified portfolio, not heavy tech exposure, which makes it a great complement to a tech-heavy portfolio or tech-heavy positions like the S&P 500 or the triple Qs, and you earn that solid dividend. So the question many of you ask and continue to ask me on a regular basis is now the time to sell SCHD. And again, I talked a second ago about the cracks we're starting to see in the economy, the cracks we're starting to see in the labor force, the rotation out of certain sectors. And that's why I think we need to start entering SCHD. SCHD is a long-term position for me. SCHD is a compounder of wealth for me. And based on all that, I continue to believe we're going to have a shaky November. And I think we could have a very shaky 2026. So for me, I'm going to continue to hold SCHD in my portfolio. It's a top 10 position within my portfolio. And if you're interested in seeing my entire portfolio, what I'm buying, what I'm selling, then join my Discord and become an Edge Plus subscriber. And if you're interested in options, become an Options Edge Plus subscriber, where I show all of my trades and how I generate close to $10,000 per month in income strictly from options. You can check out that link down in the description below. So thanks for watching today's video, and hopefully again you found some value from this video. You feel more comfortable with SCHD. And if you did find any value, show your appreciation by simply clicking that like button down below, and also subscribe to the channel and let me know just real quick in the comment section whether you own SCHD or you don't own SCHD. Thanks again for watching, and we'll see you in the next one. Take care.